Today we're discussing Ford Motor Company, ticker F. This company has a market cap of $51 billion, enterprise value of $96 billion. So you see about $45 billion in net debt on this business, and we're going to discuss both its valuation and its business quality today. Industry is in the automobile industry. Of course, the Ford Motor Company develops, delivers, and services a range of Ford trucks, cars, vehicles, SUVs, and luxury vehicles worldwide. Has the Ford Blue, Ford Model E, Ford Pro, Ford Next, 4 credit segments. But all of that's basically irrelevant. All you need to know is this is a company that is based and desired in Michigan of the United States. They produce U.S.-based vehicles under the Ford brand. That kind of gives you the overview of what they do. Ford Motor Company, one of the most well-known car brands in the world, but certainly in the United States. Beta of 1.51, that tells you it's going to be about 50% more volatile than the average company S&P 500, which is a good marker for it to be a relatively lower quality company. The more volatility, the less that their earnings tend to be stable. Their stock's going to bounce around a little bit more. You're going to see a little bit more of a cyclical business. That is what we would expect, and it's what we see in this return on invested capital chart as well. You can instantly see the earnings and the returns bouncing around all the time. It looks like you lost money, of course, during the 2008 financial crisis. You had 3 years in a row of losses, which 3 years of losses in the last 20 years is not great. 3 years of losses in back-to-back years is actually quite poor, because what that means is that's really hard to sustain on a balance sheet to have years and years of consecutive losses. So I don't like seeing 3 years in a row of losses. It looks like they also lost money in 2020, but that was, of course, the COVID year, and they lost money again in 2022. So we have 5 years of losses in the last 20 years, which is actually very poor for what I would want to see when a business that I'm owning. Now, 5 years of losses, another caveat here that you need to remember is that is, 25% of the time they're losing money. You have to average that out across the years that they make money, and it just tends to be a sign of a lower quality business. Average to low quality is what we're on track for here. Now, we do see that they peak out at 18% returns in 2011, but other than that, it looks like they never have double-digit returns on invested capital, which is a negative sign as well. The other piece I want to touch on is even though they don't lose money in all these years, you do have quite a few years of relatively low returns. 2019, it was basically a break-even year at 0.02%. 2018, 1% return on invested capital. 2016, 2%. 2014, less than 1%. 2009 was 2%, and then you had 3 years in a row of less than 2% as well from 2003 to 2005. So again, a lot of low performance years as well, even when they managed to eke out a profit. So this overall tells me, again, this is not a great business that I'd be super excited to own. So it all is going to come down to valuation. Now, one of the interesting things is you're having all that leverage. Of course, this $45 billion in debt is what's turning your return on invested capital from 2.3% into a 13% return on equity. That's, of course, the power of leverage. The return on equity is in that range that I start to get more excited. But again, most of this right here is telling me it's going to be a relatively low quality business, so you got to be a little bit careful. Now, the PE ratio here says it's negative, and that would be based upon some negative backwards looking earnings. So we're going to have to do a deeper analysis on the earnings to really understand what a normalized earnings might be. Overall, these other numbers, though, look pretty good. Very low price to sales ratio, very low EV to sales, very low price to book. So it's not like this company is substantially overvalued necessarily, but you also have relatively low growth rates. 1.7% revenue growth, 3% asset growth. Now, there's no numbers here for free cash flow or earnings per share. When you end on a loss year, that is what you would expect. Now, they did earn, it looks like almost $3 per share in 2013. You have a lot of, and then 2021, you earned $4 a share, but it's really unpredictable. You don't really see any clear pattern. $2.94, 31 cents. That's a 90% drop in earnings in a year. And then it 5X's to $1.84. Then you drop by a third. Then you go up by 67%. Then you drop in half. All of this is very unpredictable. And when you have that unpredictability, it's very hard for me to say what the future is going to hold. I mean, when we look here and we're saying, okay, we have negative earnings now, which is why you're trading at, 26 times, negative 26 times this, negative 50 cents. That's your $13 a share. That's what you're at now. Now, if you say on your 2021 earnings, hey, that's $3, that's a PE of 3. But right now it's negative. So and you average out these years, and now you're having, maybe $1, and maybe it's a PE of 12 over the last 3 years. The problem is even if you average in the next 2 years before that, then it's even worse than that, because it's not like you're ever above $1 except 1 year in the last 5 years. And of course, it's not an unreasonable number here, but it's just somewhat concerning. You also see they had to cut the dividend in 2019, and it looks like they maintained the dividend the same for 5 years in a row from 2015 to 2019. That's showing that the company is not expecting, standard reliable growth, that they're having to make those changes. I also question paying out a 50-cent dividend when you're losing money. You lost 50 cents and you paid out 50 cents in dividends. That's a really weird capital allocation decision. I don't really like how that's being managed on terms of the business. One thing as well that you want to see here is it's not like it's just EPS that's bouncing around. Your operating profit numbers are bouncing around a lot as well. 12.8 billion, 7.2 billion, 14.3 billion, and then it drops down again, to 400 or to 4 billion, up again to 9 billion. These numbers are all jumping around. So it's again not just an EPS distortion. If we're enjoying this video, if you're learning something, please hit that like button. Of course, I understand this might not be your favorite company, but I'm really trying to add value so you can understand and evaluate when you see these types of things in the future yourself. The other piece, of course, here is you can see the gross profit margin jumping around. One of the reasons that your operating profit did so poorly going from 2013 to 2014 is that although revenue is only slightly down, cost of goods sold went up, which caused a big drop in your gross profit. But at the same time, your SG&A also went up. So your SG&A is increasing by over 10%, basically 10%. But you had a 20% drop in your gross profit caused by only a 2% drop in your revenue. And it's because you also had a 2% growth in cost of goods sold. So this is all sorts of negative operating leverage leading to this massive decline in your operating profit. When you think about it as well, they have so much debt on this business that a change like that can absolutely destroy the pre-tax income numbers, because you can see there's just this massive amount of interest expense that they're paying on this company. $7 billion in interest expense. You compare that to your $7 billion operating profit, it completely wipes you out. What this tells us, though, if you just look at the operating profit line, we said you had 3 years of losses here. But there's not a single year where your operating profit is negative. So if you ran this business without debt, then it wouldn't be a problem. You'd be profitable every single year. So this is a capital allocation. This is a management decision to run this company with a lot of debt, and it's causing it to look a lot worse than it otherwise could be if it was managed without debt. Now, it might be a low returning business without debt, but at least you wouldn't have this, very cyclical nature because of this high fixed cost of your debt. Now, you're basically flat on shares outstanding, of course, across the decade. So there's no real standard decision being made there. If we go to our balance sheet, I want to see PP&E. So our PP&E is up almost 50%. So 40 billion to 58 billion. You're at 60 billion here in 2021. So you've increased your PP&E about 50%. Let's look at our long-term debt. Your long-term debt is up a third, which is a good sign that you're not increasing your PP&E faster than your long-term debt. Now, the debt did go up by 22 billion and the PP&E went up by 18 billion, but on a percentage basis, it's being managed somewhat well there. So that's not a problem on its own. It says you also have $50 billion in short-term debt. Wow. So you start out with $38 billion in short-term. That's a lot of short-term debt. Is this like on a revolver? This is a huge amount of debt. You have $50 billion here, $88 billion here. That's $138 billion in debt. And that's against, $58 billion in PP&E. I guess you got some inventory it's against. You have accounts receivable. Whew. This is a very debt-intensive business. You're definitely funding the vast majority of this balance sheet with debt. So it just brings into question what your returns could be if you could operate without debt, could operate without those interest expenses. Your returns on capital would probably still be low because basically this whole decade, they have had assets in the 200 billion range, right? And so what's their peak earnings? So 200 billion, and we just go to operating profit. You're talking about maybe a 5% return, 7% return on your operating profit. 5 to 7% returns is kind of low. So you would kind of want some debt in order to get the shareholder returns into the double digits. But I think they could operate with a lot less debt because I think it's causing more problems than it's helping, at least on this quick review. So if we go to cash flow statement, Again, you can see the big gap here, cash flow from operations to net income. A lot of that's driven here by this depreciation and amortization line. Now, there's a lot of bouncing up and down because you have these changes in working capital, but we want to kind of ignore that. Just focus on the depreciation. It's a pretty big number. They are matching up pretty well with PP&E, so we're not getting worse from that sort of cash flow perspective. But you also see you're issuing debt almost every year. You did have a $22 billion payback in 2021 when they had that big profit year, but you're issuing a lot of debt. There are some steady buybacks, which it looks like is just offsetting stock-based compensation, which I really hate to see. I would rather you pay them in cash. Stop paying your employees with stock. It doesn't align the incentives like you'd want, and it just causes dilution, which you have to pay even more money for over time. A lot of cash paid in dividends when they're not really earning that money. I don't know. So for me, Ford is a company that does not look interesting at all. This looks like a bad to average business, very, very cyclical, completely unpredictable from a bottom line basis, which means I have no idea how they're going to do in the future. None at all. This is a company that you could maybe consider trading if you know how to time the automobile cycle, but that's outside of my expertise, so it won't be going on my watch list. If you learned something from this video, please hit that like button. Don't forget to subscribe. And if you want to see the companies that did make my watch list, I have a link to the watch list at the top of this video. I hope you'll check it out. Those are my favorite companies from the S&P 500, and I think they're worth looking into. And if you would like to try out this software yourself, it is quickfs.net. The affiliate link that I have is the first link in the description below. Doesn't cost you anything extra to use that link, but it's a great way to support the channel if you sign up through my link. Free and paid accounts available. Thank you for listening, and until next time, stop paying fees, start building wealth.